This Forex strategy changed my trading and also my life. Hello everyone and welcome back to the channel. In today's video, I'm going to share the Forex strategy that completely changed the way I approach the markets. And now this isn't a magic strategy, but it does guarantee wins. And so what it did for me was bring structure, patience, and consistency to my trading. So if you're someone who struggles with entering too early, chasing trades, or feeling lost in the markets, then this video is for you. Make sure you watch until the end because I'll show you exactly how I combine my higher time frame fair value gaps and lower time frame order blocks and fair value gaps. And if you're interested in learning more about Forex trading, don't forget to subscribe and turn on the notification bell because I'll be posting new Forex content every day. Let's get started. So one of the biggest reasons many traders struggle is because they don't have a process. So most beginners open a chart and immediately start looking for trades. They see a candle moving quickly and you jump in. Then a few minutes later, the market reverses and hits your stop loss. Then you take another trade to recover the loss. And the cycle continues. I know this because I used to do the same thing. And the truth is that trading without a plan is like driving without a destination. Yes, you might move, but you're not moving with purpose. And that is why having a framework is so important. A framework basically helps you to stay disciplined and avoid emotional decisions. And the biggest improvement in my trading happened when I stopped focusing on random entries and started focusing on context. So instead of asking myself, why should I buy or sell right now? I started asking, what is the market trying to do? Where are the important areas on the chart? And am I trading with the higher time frame or am I against it? And these questions completely changed my approach, and the strategy I'm sharing today is built around these three simple ideas. First is you identify a higher time frame bias. Then second, you mark an important higher time frame area, that is the fair value gap, and then you go now look to the lower time frame where you're going to look for a series of down close candles, that is called an order block, and after that followed by a fair value gap, and then on the retracement of the fair value gap is where you're going to enter. And so this strategy is simple, but simple doesn't mean easy, but it is often effective. So how do I find my market bias? The first thing I do every day is determine the market bias, and I start with looking at the daily chart or the 4-hour chart, basically the higher time frame chart, and I want to understand the bigger picture. Is the market going higher or is it going lower, or is it even moving sideways? And the reason I start with the higher time frame is because they remove a lot of noise that exists on the lower time frame. So when you understand the bigger picture, your lower time frame decisions become much easier. So think of it this way: if the market is clearly bullish on the higher time frame, it makes sense to focus on buying opportunities rather than constantly looking for sales. And so one thing I pay close attention to is market structure. So in a bullish market, price generally creates higher highs and higher lows. In a bearish market, price generally creates lower lows and lower highs. And understanding this helps me align my trades with the overall direction of the market. And I know many traders try to catch every reversal, and I used to do that too. But over time, I learned that trading with the trend is often simpler than trying to predict when the trend will end. And so this doesn't mean the trend lasts forever. It simply means that I want the higher time frame to get my decision making process. So now let's talk about what is a fair value gap. And a fair value gap is essentially an imbalance in price delivery. And so it occurs when the market moves aggressively and leaves behind an area that wasn't fully traded through. And so many traders believe that these areas can attract price back in the future. So fair value gaps are one of my favorite tools because they help me identify areas where the market may react. However, I never use them in isolation. I combine them with higher time frame analysis and market structure. So when I find a fair value gap on the higher time frame, such as the 4-hour or the daily or the 1 hour, I wait. And this is where patience becomes critical because most traders struggle with waiting, and then they feel like you need to be in the trade all the time. But some of the best opportunities come from simply waiting for price to reach your area of interest. So you should remember that the market will always be here today, tomorrow, and in the future. So you don't need to chase it today. Just wait for the price to return. So, and I know waiting sounds boring, but waiting is often what separates disciplined traders from emotional traders. So when price reaches a higher time frame fair value gap, that is when now I become very much interested, and not before that. So by waiting for price to come to me, I avoid a lot of unnecessary entries, and fewer bad trades often means better overall results. So once price reaches my higher time frame area, I moved on to a lower time frame, and this could be a 15-minute, a 5-minute, a 3-minute, or a 1-minute chart. And the purpose of moving lower is to look for confirmation. So I want the market to show me signs that my idea may be correct. I don't want to guess, I want evidence. So this step helps me define my interest and improve my risk to reward ratio. So on the lower time frame is where I'm looking actually for my entries. So if I'm looking for a buy, I want to see the bullish behavior on the lower time frames. And one of the things that I look for is a fresh fair value gap that has been formed after a series of down close candles or after a series of up close candles. So instead of entering immediately, I wait for price to retrace into that lower time frame fair value gap for my entry. And so this gives me a structured entry and a logical place for my stop loss. And overall, the goal isn't perfection, it is consistency. So let's put everything together. First, you identify a bullish or a bearish higher time frame fair value gap. Second, you wait for the price to return to that area, that order block. Then third, you move to a lower time frame, and then you wait for that lower time frame fair value gap that is after a series of down close candles, and then you enter, and now you start managing your trade according to your plan. So this entire process helps you to avoid emotional decisions and keep you focused on the quality setups. And before I forget, one of the most important lessons every trader actually should learn is that losses are part of the trading. No strategy wins every time, and that is where stop losses are important. So before you place any trade, know exactly where your stop loss will be. You want a setup that if it becomes invalid, you want to exit quickly and move on. So protecting your capital is one of the most important skills a trader should develop. And just as important as knowing where to exit a losing trade is knowing where to also take profits. So I typically look for logical targets based on the market structure. That is, it could be previous high, it could be a previous low, or another important level on the chart. And also it has to be a low hanging fruit. So having a predefined target, it helps you to remove the emotions and allow you to follow your plan more consistently. So if you were to remember only one thing in this video, I want it to be this, yeah? Risk management, it matters more than any strategy. You know, a trader with excellent risk management will survive mistakes, but a trader without risk management will lose an account even with a good strategy. So focus on protecting your capital, and then think long term, and then know that consistency is built over many trades, not just one trade. So a quick recap of key lessons on this video is that start with the higher time frame bias, mark a higher time frame fair value gap, wait for the price to patiently return to that fair value gap, then use a lower time frame order block accompanied with a fair value gap for your confirmation and for your entry, then manage the risk on every single trade. These are the core principles behind the strategy. I hope this video has helped you, and you now know you understand how to use higher time frame fair value gaps accompanied with lower time frame order blocks plus fair value gaps. And again, this isn't about finding a perfect strategy, it's about developing a process that is easy to execute consistently. So if you found value for this video, make sure to subscribe to the channel, like the video, and share it with someone who's learning Forex. Also leave a comment below and let me know what Forex topic you'd like me to cover in the next. Thank you for watching. I'll see you in the next video.